In today's video, we're going to cover the Bollinger Band Breakout Strategy. And essentially, it's going to use volatility, and we're going to use prior swing highs and prior swing lows for trading opportunities. Quick rundown, John Bollinger created these bands, and it uses a moving average and two lines that are standard deviations from that average. And commonly, it's used as an oversold and overbought indicator. But we're actually going to be using oversold and overbought as signs of weakness and strength. There are three main components to the band. There's the moving average, and it's a simple moving average, and the default setting is 20 periods. And traders change that number. They use various numbers. The upper band sits 2 standard deviations above the moving average, and the lower band sits 2 standard deviations below the average. And again, all those numbers can be adjusted. Now, the premise behind the indicator is that with these settings, 80 to 85% of all price action is contained between the upper band and the lower band. And any time you see price going to the bands, it's time to take notice of the instrument that you're looking at. And I want you to notice that the bands do not stay in close proximity to each other. During periods of low market volatility, you're going to see the bands come closer together. When high volatility is present, you'll notice the bands will start to get further apart. So we're going to use that feature of measuring the higher volatility as part of the Bollinger Band strategy. And if you're looking to take advantage of low volatility conditions, you can check out the Bollinger Band Squeeze video. So there are generally 3 strategies that people use with the Bollinger Bands. They use breakouts, they trade reversals back to the middle line, or they trade reversals from the middle line. But we're going to focus on breakouts with the idea that we could catch the beginning of a strong trend. You can use any market, you can use any time frame, doesn't really matter. So for the settings, we're just going to use the default settings. We're going to use a 20 period simple moving average for the middle line, and our standard deviations will be set to number 2. And you're going to be looking for an increase in volatility as well as support levels or resistance levels being broken. Now, the strategy is going to use breaks at these levels, and these breaks will actually indicate the trend direction. So to avoid trading in consolidated markets, you may want to consider the slope of the bands. So here we see the slope of the bands in both a trending and a consolidating instrument. Each trader is different. Right? We're all different, and some may filter out trades in consolidated markets. There is no one size fits all to trading, and volatility contractions may suit some traders. In fact, you may actually find it a really great addition to the strategy. You can also increase or decrease the time periods on your chart when you see things are in a trading range, because you can often find a trend on a different time frame. So talking about trading signals, we're going to consider a sell signal for shorts on a time frame that a day trader may use, and that's going to be the 5-minute chart. So as part of our rules, we're going to be looking for price movements that not only break the lower band, but also a price support level. So looking at this chart at number 1, we see price breaks a level of price support. Number 2, price moves through the Bollinger Band to the downside. At number 3, we see price breaks the low that was over at 2 and goes through the bottom band. And number 4, that's just a long trade. So as this is a short time frame, day traders may want to ensure that your stop loss is adjusted as price moves in your favor. So where would you set a stop loss? Well, we all know that managing risk is vital, and one part of it is knowing where your exit point is going to be. The simplest method, just use the high of the candlestick that triggers the trade when we're considering short trades. And as price moves in your favor, you can use a trailing stop to lock in profits. Let's take a look at a daily chart. It's a pretty simple setup for swing trades. Number 1, price support level gets broken. Number 2, price had broken the lower band of the Bollinger. Now, there are different ways to enter, and traders are going to have to decide if you're just going to enter on the break. You're going to enter when price closes. You're going to sell stop your order to go short once it breaks the low of the trigger candlestick. whatever you use, just make sure your trading plan has your exact entry and your exact exits written down. Let's look at buying. So what goes down will probably go up eventually. So let's look at some buy examples. Now, really, buying is not going to be a whole lot different than sells, but let's just break it down here. This is actually a picture-perfect daily chart setup. Price, at the same time, has broken resistance and the upper Bollinger Band. Your stop will go right under the entry candle that's highlighted by that black arrow. Beautiful trade. Can we do long-term trading? Sure. Right? It works well for day trading. Let's take a look at longer term. Here, price breaks the upper band and it stalls around one of the resistance levels. That's not necessarily a bad thing. Once price breaks out of the last resistance level and pulls back, price takes off into a new trend while taking profits. One of the easiest ways to take your profits when you use Bollinger Bands, using a long trade, for example, is if price pulls back into the middle line. It's a great trailing stop. So in this case here, that weekly chart pushed upwards and would have exited for a 19% price gain. This is a 15-minute chart. And I like this example because it wraps up a lot of what we just talked about. The trade signal entry is pretty obvious as it broke a resistance level and the upper Bollinger Band. And now for this uptrend to continue, the resistance has to break. So this is actually a really good spot to consider taking profits, as it used market structure known as a double top. For shorts, same idea would be a double bottom. This new entry works out pretty good and eventually gets stopped out with a trailing stop on that moving average. You can see it there. So the rules of this trading strategy, they have to suit you. So you're going to have to really flesh this out a little bit. But this discussion, I think, is giving you an entry setup as well as the bones of stop loss management. So whether you ride the trend or you take profits at certain points, that's all going to depend on your trading style. In a perfect world, we get a breakout, then we get a strong uptrend or a downtrend. Now, it's not always going to work like that. So obviously risk management is something you have to spend time on. And I know some of you look at these videos looking for a full-blown trading strategy, but if someone can give you the shell of one, and then you can take the knowledge that you currently have and build your own, that's a heck of a lot better. Anyways, thanks for watching. Make sure you hit like, subscribe. Any questions, comments, put them below. And we'll check you at the next video.